Good morning, everyone. Very excited to be here. My name is Greg Goldfarb. I'm Managing Director at Summit Partners. I'm thrilled to have the opportunity to moderate a great panel for you. And the panel you see is Will and Why Will the Capital Markets Reward Customer Success in 2016? And I'm particularly excited about this topic because the first 20 years of the SaaS industry has been all about the acquisition engine. If you break apart a business into the engine of acquisition of a customer and the retention and expansion and engagement beyond that first transaction, the whole first 20 years of SaaS has been about the acquisition engine. And I think the world is beginning to switch and understand the importance of what happens beyond order zero. That's beginning to permeate not just SaaS, but other types of businesses, anything in which there's more than sale one that occurs. So without further ado, there's a short video that's going to introduce our panelists, and please run the video.
Continue.
I should continue. There we go. Well, there is no video. All right. David?
I'm the video.
Todd?
Thanks.
Danielle? Tomasz. So we have short time, and I'll give very quick intros to everybody. We've got David Spitz of Pacific Crest, who's a managing director. David has been studying and analyzing the public SaaS market for a very long time now. Some very interesting comments from that perspective. Todd Gardner of SaaS Capital is a co-founder and CEO of that business, managing director of that business. Danielle Morrill runs a business in Silicon Valley called Mattermark, which has some very interesting insights. And Tomasz Tungus is the managing director or partner at Redpoint Ventures. So we got lots of interesting people. We'll grab a seat, and off we go. So to start, I'll try to advance the slides here.
Working.
All right. So when this panel was coming together, the original topic was why the public markets will reward customer success in 2016. And as we got to talking, we started with a fundamental question of, do the public markets have the same understanding of customer success as the private markets do? Does anybody want to take that? Maybe David, I'll point to you.
Sounds like I don't have a choice. Sure. And I promise not to make Jason jump off the tower next door with too much of the acronyms. But I mean, the short answer is a little bit. The biggest issue is the public markets don't get enough information. So private companies reveal a lot more information through great tools like Gainsight. When they go public, they have to reveal some information, but they don't reveal the type of information that gives you a really good view into some of those acronyms that will remain nameless here. But what we do know is that there's been a pretty dramatic change in the way the public markets have looked at SaaS companies certainly over the last 6 months, but really starting about 2 years ago. And so the chart that is on the screen here basically flashes back to the beginning of last year, the very beginning of last year, January 15. And what you see on the x-axis is revenue growth, and growth is certainly rewarded in the public markets, even now, as we'll see in a minute. But and then what you see on the y-axis is the valuation expressed in a revenue multiple based on forward 12 months. I won't get too geeky here, but you see the coloring here is based on profitability, and profitability is typically measured for these companies not in net income, but rather free cash flow. That's a good measure of profitability that you can actually tangibly see. And so green means already free cash flow positive, gray is break even, roughly, and then different shades of red, obviously the darkest being a good ways out from free cash flow positive. So you see some of the dark reds all the way to the right growing fast, companies like Castlight, New Relic. They're dark red, meaning that they don't go cash flow positive for at least 6 quarters, so basically as far as the eye can see, based on research analyst estimates. So you see, not too many companies that are free cash flow positive as of last January, about 15 months
ago. So David, 16 months ago, you could draw a line, a regression line there, and say, roughly speaking, there's a loose correlation between growth rate and multiple,
Yeah.
but almost nothing else, right?
Almost nothing else. There's certainly some other things, but we won't get into that. But there's a pretty good correlation, I would say. So let's flip to now. This is about a week ago, by the way. But so two big changes here. Three. Number one, valuations have come down. Duh. I mean, we've seen that, right? Number two is the correlation is not there anymore overall. But if you look, you'll see a lot fewer companies are dark red. Not surprising. A lot of people have basically said, we need to get profitable faster. That's what the market's demanding. And the ones that are free cash flow positive, many of them bigger, the size of the ball represents roughly some of the size of the companies. There is some correlation within that, though. So for the green group, there is some correlation. It's not as steep a curve. And people who are dark red are getting seriously penalized. So a lot fewer companies. There's been a big reaction in the market. This comes back to the topic of this panel. Free cash flow, it's not a direct measure for how you do customer success, but obviously, if you're paying attention to how much money you're making, you're paying attention to things like how efficient your business model is, your churn, and ultimately your free cash flow. There's still correlation among the red folks, but big reaction over 16 months.
So the public market has gone from valuing growth to some extent to valuing free cash flow as its primary metric. And question for the other panelists, are you seeing this happening in the private capital markets as well?
We definitely have seen a change in the private capital markets. It's not that, so Redpoint is primarily a Series A investor. So we invest in early stage companies when they're about 15 to 25 people. And it's not that the companies coming in are suddenly saying, hey, we're profitable when we pitch. But what they do come in and say is they focus a whole lot more on unit economics than they have in the past. And we ran an analysis of premium SaaS companies. We tried to figure out what the best correlator was to post-money valuation at the Series A. And it was not MRR, it was not monthly recurring revenue, it was not revenue growth. It turns out it was churn. And so if you have a negative churn, that correlates to, the greater the negative churn, the greater the valuation. And the R squared, the correlation coefficient, is about 0.56, which is twice as strong as revenue or revenue growth. And so what that tells me, and when we look at that analysis, is that account expansion is the leading indicator of product market fit, right? And that's what we really care about when we invest.
So Danielle, you run a fast-growing, recurring revenue business.
Yep.
How have the capital markets changed anything you prioritize in your business?
Yeah, so we were fortunate we raised right before this change happened, but I would say it depends on how long of a view investors are taking. So in Tomas's case, or in our board's case, focusing on negative churn and thinking about how it's going to play out in years is possible because they're not worried about the stock price this quarter or next, whereas if we were reporting earnings, we would look terrible right now. Obviously, we're burning to grow. So I think it's just the message we're getting is be careful, be thoughtful. It may be harder to raise, there might be more friction, but ultimately you still have to invest in the long view, and that means you still have to invest in things like customer success because they don't pay off in a quarter. If it's an annual contract, then you're not going to see that benefit of expansion revenue until that renewal point, which could be way out in the future. So I think keeping the long view and not panicking is the message that we're getting at the board level.
And Todd, you've got an interesting cross-section of companies that you work with geographically, right? All over the place, all over North America, basically. How has the change in the capital markets environment shifted what you're hearing about customer success and the metrics that we typically associate with customer success?
Yeah, I don't know that it's a whole lot different other places. Although you and I mentioned there's a creeping CAC ratios. Jason's so tired of hearing about them, but in other parts of the country, they're just sort of getting up to speed on some of those metrics. And I think to some degree, our job is to communicate, what the power of the churn metrics really is. And you mentioned, and I'm going to talk about it a little bit later, the cumulative impact of churn and how that really makes a huge difference. And I think folks, even when they're doing the ROI calculations or looking at the public comps, are still actually underestimating the impact. So I was very interested in your comment about it's the single biggest corollary with valuation, and it's because it impacts revenue growth, it impacts profitability, it impacts MRR,
Yeah.
and so you peel it back and you find like it's the real driver, which is amazing. I don't think we were there a couple of years ago.
I think the biggest thing is, as the cost of capital increases, which it has in the past couple of, call it months or quarters, particularly for early stage startups, you need to grow with less money, right? Because each marginal equity dollar costs more in dilution. And so the better the better your metrics are, unit economics wise, the less capital you need. And it can have, like a 4-point, for a Series A company over the next 24 months, if the difference in the amount of capital you burn, if you're 4% gross churn versus negative 4% net churn, there's you need 1/10 the amount of capital to hit the same growth rate. Like it's 8 million versus 800,000, right? And again, as the cost of capital increases, like it just becomes more and more expensive to be less efficient. Right?
Yeah, we put some analysis together to look at what a high churn and burn business looks like in terms of volatility in different market conditions. And what this slide shows is you take the same two companies. One starts at $10 million of revenue, grows very fast and burns a lot of cash. The other starts at the same level, grows very nicely, but never burns cash. And what you see is extreme sensitivity to changes in discount rate, which is the cost of capital that's funding these companies. And so you look at the dark black line, and that is Bravo company, and the dotted line is Alpha company. What you'll see is that Bravo never has the high highs that Alpha does, but it also has much, much less volatility in the valuation. And so this is a way to sort of demonstrate or communicate the value of a balanced business or a business with a strong LTV engine inside of it. To switch now to the question of is the perception of customer success changing, right? The function itself. In the different capital markets in which we all play, is there growing recognition of the importance of this function, of this department? Is there no change? Is it declining? Are people pulling back on investments because they're scared about profitability? What are you guys seeing around this particular function?
Well, I mean, from the public market standpoint, honestly, I mean, this is not maybe what people want to hear, but I don't think there's direct recognition yet of that particular function. I mean, for one thing, there's a lot of confusion about where that cost would be applied. Is it in the gross margin? Is it in the operating expenses? So people have on the public side become much more cognizant of churn, and they still, there's still confusion around gross churn and net churn and how all that works. But it's much better. It's worlds apart from where it was 5 years ago. But they're not quite there yet, honestly. On the private side, for sure. I mean, we deal on the private side as well. And there's a lot of recognition there. I think, it may be disheartening for some people, though, that are in businesses that inherently don't have as much land and expand in the early years and don't have necessarily the negative churn. Those can still really be good business models. It just has to be inexpensive enough to get those customers, whether it's a freemium product or something else. There are ways to make those models work too. So I don't want to dishearten folks. There are companies, people that were presenting yesterday. HubSpot's a good example of a company that is tremendously successful. They don't have negative net churn. They have churn that continues to improve. At least they didn't when they went public, but it's continued to improve, and they have really good underlying economics. that make it cheap enough for them to get new customers. And so it works out beautifully for them as well.
What are the rest of you guys seeing as the capital markets change? Do you see people doubling down on customer success, or do you think people start to pull back on all investments, including things that produce long-term value, but not necessarily immediate value?
Well, I have to jump in here. I love this graph. I think this is so great. So if you're a CEO looking at this graph and you have a VP of customer success, or in our case, we're hiring for one right now. Hi. Had to get that in there somewhere. But if you look at this graph and you say, okay, do I want to be alpha company or do I want to be Bravo company? And in this market, being Bravo company is being rewarded. So if you put this up and you say, how are we doing? Are we moving towards being Bravo company? It's not like you put the cash in the bank. So you talked about an $8 million versus $800,000 difference. It's not like I'm going to sit on that savings. I'm going to go invest it. So actually, as we produce higher quality revenue, as the market puts pressure on our business to produce a different kind of revenue, it's awesome because then you have that free cash flow, that 20% margin, you spend it. You don't keep it. You don't just put it in the bank. So I think on the private market side, the businesses that are efficient, they're not going to just bank that for a rainy day. They're going to actually go and they're going to take advantage of their strong position. So I feel like this is an opportunity right now. Any company I'm competing with that doesn't have as good a free cash flow as we do, I feel like this is my opportunity to kill them with customer success. I feel like that's my opportunity to make my revenue quality higher and higher and higher. And every day the market is in turmoil is an opportunity for me to go and build a better business.
Killing them softly, right?
Absolutely.
So in the private markets, I think I've noticed two changes in the past couple of years. The first is lots of companies are now getting to the point where customer success drives more new bookings than sales, right? And that typically happens for really fast-growing SaaS companies at around year 3 or year 4, where year 0 is the first year they commercialize. And that's a pretty big mindset when, historically a cost center for a company is actually driving more new business through account expansion than the sales team, right? And so then the question that's raised to these late-stage companies at several hundred people is, what does the right leader for the customer success in the sales organization look like in that situation? And we don't know the answer. And the second big change that's happened is, I think looking at yesterday or hearing yesterday's talk, everyone agrees customer success is really important, and whether or not it's appreciated in the public market or the private market doesn't really matter. Everyone appreciates that it's a really tremendous growth mechanism, but how, right? Like, how do we actually build a best-in-class customer success organization? What are the tactics that we need to use every day in order to move the metrics? And the third thing, I'll add a third thing. The third thing is people are starting to realize that customer success is not just within the realm of the customer success department. The way that the sales team sells will impact your churn rates. The way that the marketing team positions in either under promises or over promises will impact your churn rates. And so the customer success is one piece of an interlocking business, and how to synthesize that, what those tactics are, and how to scale that organization as it ultimately generates much more new business than the sales teams. Those, I think, are the three major questions facing customer success executives today in private markets.
So many of us in this room live in the private capital markets, and one of the things we want to talk about is the capital markets broadly, which include the public capital markets. And one of the interesting things that we all observed in talking about this topic is there are no standardized reporting metrics for public companies. There's no obligation, there's no gap reporting on your customer success metrics in any sense. And so people have just defined their own. David, maybe you could hit a little bit where the market might be going in terms of the public market might be going in how it measures the success of customer success.
Yeah, so this chart doesn't, okay, I see what this chart is, sorry. So yeah, this is a ServiceNow chart that actually reflects the land, expand, and retain. ServiceNow, obviously one of the top companies in terms of market cap, in terms of multiple, in terms of the success that they've had. And they are, I would say, by far, the ones that are the most transparent out there. It might be because their metrics are so darn good, right? That probably has something to do with it. There is no requirement, just so starting where we always start when we take a company public, you figure out what you have to disclose, and then of course you want to put the right story in place. You can take a cynical view about how that all comes together, but generally you want to show, you obviously want to position the company, and you want to provide some mechanism beyond just the pure financials to give people a sense of how the company is doing. But you want to do it with a, obviously good positioning. And most companies now will describe some element of churn. It's typically the metric, surprise, surprise, that gives churn the best patina. And so it's typically net dollar retention, which includes the upsells. Right. Having said that, you think, all right, at least we have some standardized metric, maybe not the one that we'd like the best, which would probably be gross churn without the upsells, but at least we have a standardized metric. Well, it's not so simple as I think all of you know. There are a million ways to measure this, and of course, people tend to select the one that works the best for them in terms of what they disclose publicly. So to answer your question as to are we coming to a point where, by the way, the SEC does pretty much now, even though it's not a technical requirement, if you don't disclose something like this, they'll come back at you with a comment and say, you need to give us some notion of what's going on with respect to churn. I am somewhat cynical about the notion that we're going to get these public companies to voluntarily disclose, for example, these metrics, which are, as I say, very transparent, because there are some warts. Every company has them pretty much. ServiceNow maybe being the only exception, one of the few exceptions. And until the SEC or somebody gets pretty savvy on this, it's going to be difficult to get companies to gather around some kind of a standard, unless somehow we get the grassroots, the best companies doing exactly what ServiceNow does. Maybe there'll be some peer pressure.
We may find a lead by example type scenario where the best performers start to report on these metrics because they're such powerful drivers of their enterprise value.
That's right.
And it forces everyone else to...
You want the same multiple? Go ahead
exactly.
and disclose the same metrics. And so that may be the one way we sort of get there.
Todd, you guys have spent a lot of time thinking about the relationship between customer success and the metrics it drives in terms of expansion and retention, and how that relates to enterprise value and the driver of value. Do you want to describe for people what you guys have looked at and the impact of your work?
Yeah, sure. So this is essentially like the A and B company chart that we saw before. You've got a revenue line going up and to the right over years, and the green line we call retention Inc., and it's got a 95% net retention rate. Pencil in whatever number makes sense for your company. And then a higher churn company down below that's around 80, 85. And the couple of things to point out here, and really the key message is it's cumulative, right? So back to the comments earlier, like in the first year or two, you can barely tell the differences in revenue between those two businesses. But by year 5, there's a 40% higher ARR for that high retention business, 40% more revenue. So one of the drivers of valuation is obviously revenue. It's also a 50% higher growth rate, which is still a driver of valuation, right? Even with the pivot towards profitability. So, we do all of our planning and all of our reporting in these 1-year increments. But if you want a chart that really demonstrates value of investments in customer success, and again, you have to draw the dots between customer success and improved retention. I think we all know there's lots of pieces to that, but there's the ROI, which is sort of accounting and cost and payback inside your own financial statements. But in terms of valuation, demonstrating to folks that this is a cumulative thing, it gets bigger. Investments now pay off in the future, I think is very important. And the final point on the slide is, and this is a little nuanced, but the higher your retention, the higher your addressable market. If you churn through customers, you're going to run out of customers in your addressable market. So the one other thing that the public companies' valuations and even the VCs look at is how big's your addressable market? Well, actually, better retention increases your addressable market almost magically. So it's even another driver.
And this is, many of us participate in vertical markets, right, where it's a defined industry segment there's a universe available to us to go after. And if you think about the difference in your real dollar addressable market as a churner versus an expander business model, it's a profound difference in your ultimate revenue opportunity as a business. We study this a lot. I guess I will close as we run out of time here with a thought that this type of thinking, and I think we all probably see it, is not just for SaaS businesses. We see it pervading every type of business, from software to hardware to financial services in our portfolio. So this practice that all of us in this room are engaged in is beginning to flow back through all industries, not just the SaaS industry where it got started. So fascinating time for this customer success industry. Thanks to all the panelists for a great discussion. Really appreciate it.